We talk about the yield curve. It turns out there's more than one yield curve we need to look at. I'll put a chart up here right now that compares U.S. with Japan, Germany, and the UK. One of the things that Brian said was Germany's got a real problem. China even is concerning too. U.S. doesn't, and we tend to lump it all together. In fact, they're different stories.
They are different stories, but the pricing mechanisms are very powerful. Every bond market, especially the treasury market, tends to get a signal from all the bonds are competing for each other, right? There is an enormous demand for duration and limited supply, also because of all the crowding out coming from central banks. So the global yield curves it's important to focus on that because they're also sending us another signal. And this goes to the other point that I wanted to make about the limited discussion on the US recession. The reality is that Europe is practically in a recession already. Emerging markets are in a growth recession. They're growing below trend and still decelerating. 30 to 40% of the S&P 500 revenues come from abroad. So again, do we want to focus on the definition of a US recession, or do we want to focus on the fact that 40% of your revenue base is already experiencing a recession? So as market participants, I think that's more the right call, is to focus on these global dynamics. And we see that the global price of risk is far more important for domestic asset prices than even just the local price of risk here in the US.